today, the agenda is actually pretty simple. Okay, we've got like three things we're going to do. I'm going to talk a little bit about fractional acquisitions and how I've been able to build some wealth that way. Orrin Claff is going to come up and talk about the game of money, which is really, if you peel it back, it's really all about engineering your deal in order to raise around it, and like what are the variables that go into that. And then we're going to do this big deal drop that like is an investment. Okay. Now here's the thing. I'm not going to make you wait like an hour to get to the deal. I'm going to give you a little bit of info right now because like this is the thing that we all want to see. Okay. So if you don't know, this is Orrin Claff, okay? Best-selling author, pitch anything, flip the script. And the thing is that he's doing what a lot of us should be doing, which is going out and finding a deal, okay? So the big secret here is that Orrin Claff is actually the sponsor, the founder of the deal that we're going to be talking about today, okay? And what he did was he went out and found this 1.5 million square foot facility in Italy, okay? In Italy. And these guys have a technology that we desperately need here in the United States, as you'll find out in a minute. They speak Italian. There's a language barrier. This is like a small town in Italy. This isn't like Rome. You know, I mean, they don't speak English, okay? So there's a barrier here. They have no clue how to get into the capital markets in the United States. They have no clue how to raise money around, expanding in here, and they've got no boots on the ground. They've got nobody here that knows how to actually open a facility and, and make this business work, okay? That's what we're talking about. But is there a market? Yep. Okay, here's the thing. It's engineered stone. We'll get into the applications in a bit. But this is the trends of the industry. And so this blue line is natural stone, okay? That's the demand for natural stone. This green line is the existing demand that exists for the product in which we're talking about. There is one company in Italy that owns over 95% of the entire global market. They supply all of the manufacturers, and this is our partner in this deal, okay? Now, the thing is that like the demand in the United States alone domestically is 200 million square feet, but we can only produce 55 million right now. And the demand far exceeds the supply. I want to be very clear. The goal of this deal, okay, is to build a $1 billion asset in like a few years, okay? So it's a big deal. It's a big deal. So, here's basically the forecast, right? So you've got, revenue and EBITDA, okay? And the plan is to go public in a couple of years and then work up to a $60 million in EBITDA business, okay? And when you look at market comps for this type of business, it's, like every numbers that you're ever going to see, like these are conservative, right? But the thing is like this does not take an absurd multiple in the public markets in order to hit $1 billion in value, okay? So the thing is this product actually solves two huge problems that have been in this industry since its origination, all right? And it unlocks direct access into 150 million target book of orders. This is not a pre-revenue company, guys. We've got purchase orders. We have 11 million in purchase orders, and I talked directly with the customer that placed the orders and understand the impact that he's expecting this to have in his business, effectively doubling his business here in the States, okay? So here's what I'm going to talk about today, which is how to build wealth with fractional acquisitions, all right? So, okay, at the turn of the millennium, like in the year 2000, okay, I graduated with my undergrad at the University of Kansas, and I had a double degree in religious studies and English literature. So I did what anyone would do, and I went to work for one of the largest financial institutions in the world. Oh, no. Yeah, Charles Schwab. I worked at Charles Schwab, okay? And, I went out and I got licensed, I got my Series 7, and like I did all the things, and I learned about the public markets, and my job was basically to talk to retail investors about asset allocation. right? So you ask them some questions, you figure out their risk profile, you figure out their horizon, and then you give them advice around like, okay, look, there's some combination of like, domestic equities and international equities and, bonds and all this other stuff. Okay. One of the first books I read around that time was by our founder, okay? The Guide to Financial Independence. What I loved about this book was they introduced a concept that just stayed with me to this day. And the concept is this. Here's the deal. You're born, okay? You're born, you live, and ultimately you die, right? But here's the thing. When you save a single dollar, $1, it's the last dollar that you're going to spend. And as you save money, you are saving towards where you are in time. And when these two things collide, you end up with the magical financial independence moment. Okay? Okay, so why should you listen to me? My name's Walker Deibel. I've acquired 8 companies outright. I'm a minority in like almost 2 dozen more. I've got 3 startups, 3 exits, a founder of Acquisition Lab. I've been inside, personally inside, over 100 deals at this point, right? We've got, I'm a partner at Quiet Light. I've helped people exit. I taught entrepreneurship through acquisition at the Owen School of Business, and like I've been published in all these places. So I've been doing this, right? I wrote the best-selling book of small business acquisitions back in 2018, and I bought a printing company, and then I took the proceeds from that exit and a whole bunch of personally guaranteed SBA loans, and I bought a distribution company. I bought a manufacturing company. I bought a finishing company, okay? I bought an e-commerce company. I sell toilets online. It's the shit, right? So, okay, we also started Acquisition Lab where we've got, over 200 million in member acquisitions, okay? We get no kickbacks from suppliers. We take no equity. I do not invest in them. It simply is like buyers working with buyers. That's it, okay? We're economically aligned, and that was engineered on purpose from the beginning, okay? And here's the thing. What we're talking about with these fractional acquisitions, I need to tell you, I've created now an equal amount of wealth on paper with this strategy I'm sharing today as I have with buying and building my own companies, okay? The big concept I want you guys to take away is these strategies complement each other. This is not an either or, okay? All right, so where were we? Financial independence, right? Okay, so I'm sold on this idea. I'm doing it. I'm going all in. I'm an aggressive saver, okay? So here's how my first decade went, all right? So I graduate in 2000. I made my first investment in the public markets at the tail end of 1999. All right, it was like all the money I had, just put it in the NASDAQ, and then we went right into the lost decade. Okay, what's the lost decade? The S&P 500 was negative for the decade. The NASDAQ was negative for the decade. Okay, you're talking to a guy right out of college. I was probably making $30,000 after tax, being an aggressive saver. I was saving like 20%. I was living on like $19,000 a year, plugging all my money into this deal. Sorry, into the stock market, right? And this is what happened, right? So let me just, I want to put my life on this slide for you as represented by the stock market. Okay, so right here, I get laid off from Charles Schwab with 6,000 other people in the same day. 6,000 people, okay? I did my first startup, which completely failed, right? Then I got my MBA, and I did my first acquisition about here, right? So it's right about here where I've got this big loan, this big personally guaranteed loan, and my stock portfolio that I'm like aggressively saving. Anyone know what this is? It's a goose egg, right? My financial independence score at the end of the decade was like 0, right? It took until like 2013 for the market to actually start acting normal again, right? So I had this sort of realization, which was like, okay, I've been sold on the long haul like retirement thing, right? And at the same time, even though like the market was doing all this stuff, like there was so much action going on. Facebook launched in 2004, YouTube launched in 2005. The iPhone came out in 2007. The market's doing nothing. All I know at this point is like, look, you guys know this about me. It's like, look, if you're gonna make any real money, like you really need to start a business, right? But everyone in this room knows the problem. There's this little problem with startups, and that's that like they completely fail, right? Like 90% of them fail. If you talk to actual entrepreneurs, they're like, no, it's way higher than that, right? It's way higher than that. So the thing is like startups are just punishment for people that don't understand statistics, okay? Right? And so you've got this thing where like this is how I found success was like, okay, I'm going to merge entrepreneurship and the desire to own and operate, okay, with private equity. And I'm going to do it in this like small capital market where I can just go get these bank loans and like buy these small companies, right? So then in 2018 I wrote this book, okay, which sparked all of this activity over here, okay? Acquisition entrepreneurship has become one of the most popular concepts in entrepreneurship today because of the social media engine, all right? Now, here's the thing. All these people on social media are coming to the same conclusion that I had in 2013, which is, why would I buy just one? I'm going to be the Warren Buffett of small business acquisitions. I'm going to buy 17 companies. I'm going to do it this year, okay? This is Achilles, right? And when you're an entrepreneur and you take too many acquisitions on and you've got personally guaranteed loans and you have a whole bunch of different teams and you've got a whole bunch of different managers and you have a whole bunch of different customers, what ultimately happens is you're adding complexity along with high leverage. This is a high leverage model, okay? It's a high leverage model by nature. That's what makes it entrepreneur centric, okay? So if you do all that, you become the essence of this term over-levered. By stacking acquisitions on top of each other, okay, you are building a risk stack. You're going to have cash flow problems. You've got industry transformation happening. There's external interest rates, right? Interest rates. Your team. Sometimes 40% of your workforce walks out on you on a single day. Sometimes your manager leaves you hanging, okay? Sometimes your large customers are holding you over a barrel and you've got another problem over here at this other thing, right? So you ultimately are creating the Swiss cheese model of accident causation. This model can work, you're just depending on a lot of things to go right to make it out on the other side, right? So the thing is upgrading your business is different from upgrading the quantity of the businesses that you're buying, all right? More is not better, okay? Assembling a portfolio of businesses has this constraint. It's me. Or in your case, it's you, okay? Buying a portfolio of small businesses is all about capital allocation. It's no longer about entrepreneurship. So I realized what I needed to do was multiply myself, okay, into a blue-haired female. Just kidding. I needed to multiply myself. So I started thinking, okay, what I need to do is find other entrepreneurs and take the same amount of money that I would be putting down as a cash infusion into an acquisition and then buy a piece of their company, right? Pretty simple. I don't necessarily need to buy the whole entire pizza. I can just buy a slice. I can just have dinner, right? And the good news is like, I'm not making this up. This isn't like some, big genius opening moment. Like you go back to like the single best-selling book of personal finance of all time, and Rich Dad, Poor Dad tells us, hey, get to the right side of this thing. Be a business owner, be an investor. This is where you want to live. You don't want to be an employee. You don't want to be self-employed, okay? You want to be over here in these quadrants. So all I was doing was moving from here to here, all right? But I had this challenge. Right? And that's that when you look at the life cycle of a business, okay? a lot of the acquisition entrepreneurship and a lot of the success that we have comes up here when businesses are mature, right? Because we want things to be safe. We want to be able to use leverage, right? We want to be able to find things that like have history and like all these things in place and infrastructure, right? And then we want to go get a bunch of debt and put it on and have the equity build up and all these things. But the problem, of course, is that unlevered growth happens where? Over there, right? It's over there. And the problem with over there is it sometimes looks like this, which is what we're trying to avoid. Michael Kitces writes this blog, okay? He's a financial advisor for Buckingham Asset Management out of St. Louis, actually. And he writes a blog for other financial planners, okay? Other financial advisors. And he said, okay, look, I want to ask this question. How do like billionaires really become billionaires, right? Like we're advising all of these people and like the people I'm advising aren't becoming billionaires. Like, so what's like the little thing that makes the big difference, okay? And what he said is like, look, we all know that diversification is fundamental to financial planning. It is the way to de-risk your portfolio, right? If you own one company, you have all your eggs in one basket, right? That's where the phrase comes from, right? So he said, okay, if you actually look at like the billionaires, they don't actually diversify at all, until much, much later. And he came up with this concept of like looking at concentration versus diversification. And the analogy here is that plants will sort of like branch out and stretch their branches to get so their leaves can get sunlight so they can grow. Okay. And so what he realized was, okay, if you start, that's an analogy for diversification. If you start diversifying too early, you're not going to grow very high, right? You're not going to grow very high. If you don't, I mean, owning a business is the single best way to build any real wealth for yourself. Can we all just get over that? Like, that's true, okay? This is, this is people that don't own a business. Kitces didn't say this, I'm saying. And then you've got people who like grow some wealth and then they diversify. And then you start to look at like all of the billionaires. And like, Bill Gates was one of his examples that like even after they went public, he didn't sell any Microsoft. He stayed diversified, right? Sorry, he stayed concentrated until much, much later, where then he started to diversify. Okay, and redwoods do exactly the same thing. They grow in height before they branch out. Okay, so the concept here is that when you are concentrated in your active endeavors, okay, you are building wealth for yourself, right? That's what we're doing with our businesses. When you diversify in active, you're building a risk stack because you can't manage an octopus, okay? But when you diversify in these passive investments like this, like the public markets, okay, it's just too slow. Like it's this like, 30-year retirement plan situation, right? So like how do we marry these concepts of like, being an entrepreneur and building wealth, but then also increasing the TAM, the total addressable market that's available to us, right? So diversification reduces risk, but how can we diversify and get the active returns? I've come up with the anti-Kitces thesis. Okay, so the core issue is that access to high yield assets has been limited to publicly traded, market efficient, correlated assets. Capitalizing on the inefficiencies that are found in the private market, is the single thing that gives us the outsized gains that we're trying to achieve, right? So where can I find investments with market inefficiencies becomes the question, right? Alternative investments, okay? Alternative investments is made up of 3 core categories, all right? You've got private real estate, private equity. We'll make private equity Kurt Cobain. And you've got private credit, okay? Private credit. Now, here's the thing. There's a group called Tiger 21. In order to get accepted into in order to apply to Tiger 21, you have to have $20 million in liquid investable assets, okay? The good news about Tiger 21 is they actually publish the diversification of their members, okay? These are ultra high net worth people, right? Defined as 30 million in net worth or above, okay? By the way, just so you know, other like rich people don't even consider you rich until you have 30 million. That's a pretty high number, right? For that pocket. But here's the thing. Look at this. Look at this. Where are they putting their money? 55% is in private real estate and private equity. 29%, the single largest allocation that they're holding is up here, right? And where are we? Where are we? We're like 100% down here. This whole entire graph isn't open to us until Buy Then Build came out, and then we all ran out and bought a business, right? But why would they do this? Why are they doing this? Like, is it really the market inefficiencies? Yeah, it really is. Okay, private equity and venture capital, which is a different game, but you know, you got it. But so the point is like private equity has outperformed the public markets in 25 of the last 25 years. I think venture capital, the public markets did better in 1 year out of the last 25. And private equity, all 25 years, we've done better. Okay? So how do we get into these deals? How do we get into these deals? The Jobs Act came out in 2013 and changed everything. This used to be a super rich game, and we couldn't get access to these deals. The Jobs Act changed that. The fact that we can have this event today and introduce a private deal to all of us is something that is very, very new, okay? And so the thing is private equity hit $1 trillion in 2006. Cool? Cool. That's awesome. That was a while ago. In 2025, the same asset class, $14 trillion. $14 trillion make up this asset class, okay? It's the single fastest growing asset class out there, okay? Single fastest growing. Now, here's the thing. I'm going to tell you a little bit about my journey. And the thing is I had this advantage, and that's that I was born in the 90s, and so I already was alternative. So like alternative assets were totally approachable to me, okay? But I've bought some things, okay? I made an investment in a coding academy. I made an investment in a data-centric marketing firm. I've made multiple investments in film and entertainment. I've built a team around energy. I've built a team that I work with around real estate. And I've built a credit fund portfolio. I sold my house, last year, and I had paid it off. But then I took all of those funds and I built a portfolio of credit funds. Okay, and now I have multiple people paying me on average 11.75% every month. Sorry, annual, right? With payments. That's what I did. That's what I did. And each one of those things, I've put in about the same amount of money that I would have as a cash infusion into a business acquisition. Okay, 100,000, 200,000, right? And I started to look at this and say like, okay, how do we sort of think about these things, right? And so when I think about private equity, it's a little bit more patient, right? But it's where you get the most appreciation. And you need to have cash in order to do things like invest it in income, right? And so, you've got a lot of collateralized income in these credit funds. By the way, banks have, okay, the numbers are, I should have looked at these numbers before. Banks have gone from like 11,000, like pre-COVID, to like 3,800. Private credit is coming up out of the ashes and providing debt to other businesses that can't otherwise get it, right? And have better terms for us as investors, all right? Then you've got this thing in the middle, right, where you're giving up a little bit on appreciation, but you're getting some in cash flow, and there's a whole bunch of tax benefits in real estate, right? So this is like how all of these things kind of started working together for me in my head. So I was able to build a whole portfolio of pizza by the slice, okay? And again, my acquisition amounts were equal or my investment amounts were equal to the same as if I was buying businesses in each one of these instances. Okay, so fractional acquisitions go by many names. You could be a minority owner, limited partner, investor. Okay, there's all these things. But let's think about those three asset classes that we had before and take a step back and think about when we're doing a deal, when we're doing an acquisition, we put together a capital stack, right? Now we all know what the capital stack is. So up here you've got common equity, right? And that's sort of like, look, I'm paid last, but I own the equity. So like I get the highest amount later. And down here, this is like the senior secured debt. For us, this is our SBA loan. These are the guys that, this is like the mafia. And they're like, you owe me money this month, and you owe me money this month, and you owe me money this month. But that's all they get. That's all they get. And then there's this sort of, stack. There's this stack, first out, all the rest of it. And so I realized down here you've got maximum income, right? Then you've got maximum appreciation up there, which sort of aligns with the other things that we were just talking about. But the thing is this doesn't exist without first owning a business for me. Okay, you've got to have your business that's generating cash and building wealth for you, just as other people that have jobs like might invest in the stock market. What I started doing was saying, okay, I've got my businesses that I own, but then I'm going to use the cash flow to start putting them in all these private opportunities. And this whole portfolio is built around inefficient markets for maximum return. So I started calling it the wealth stack. It's the opposite of the risk stack, right? So, okay. So in the last 10 years, my financial independence score is, I'm not going to tell you, that's a little personal, but it's more than 0 is the point. That was the last score, remember? Okay, so the secret to well-performing private investments, okay? Do you remember, okay, in Buy Then Build, we talk about this guy, David Birch, and he came up with this term gazelles, right? And it basically was like, actually, when you look at businesses that create value, we're not necessarily looking at the size of a business. Like, it's not these big ones, it's not these small ones. Size is actually irrelevant, okay? And the thing that we want to pay attention to is how fast they're growing. So the gazelles were responsible for like 70% of the economic growth in our domestic U.S. market, right? And how do we define what a gazelle is? It's any company that starts with $1 million or more in revenue, and then it grows 20% every single year for 4 years, okay? If we were lucky enough to just find a gazelle, okay, to invest in, just over 5 years, this would be the difference in terms of returns. This is $1 million. No, this is completely theoretical, completely hypothetical. Nothing moves linearly, okay? But this is the average market return of 10%. And then this would be if you had invested in a gazelle. So instead of having $1.5 million, you would have $2.5 million. If you want $1 million, raise your hand. Okay? There's a few of you without hands up. We're gonna get you out of here. So I came up with, like, okay, what's the framework that I'm sort of using to make these decisions? Okay, and I came up with the growth predictor framework. Because the thing is like a lot of you guys are in the acquisition lab. You know that we use the 7 elements, right, to sort of like look at past performance of businesses and identify like what the value of them is, right? And so as I started to look at these other companies, right, I started to realize I'm really looking for different teams, okay, different professional teams that are in a specific industry that I'm not necessarily playing in, with a specific opportunity that has built-in demand for what they're doing, right? And they've got an edge. Now, I'm not going to unpack this whole model here right now because we've got, Oren's Game of Money coming up, which is very, very similar to the outcome of this. But this was the model that I kind of started putting together to think about how am I identifying what the risks are and how confident am I in the performance of this business moving forward, right? Okay, so just to kind of summarize here, like people make money as operators and investors, okay? Buy Then Build is pretty, like at its fundamental core, we're basically capitalizing, growing businesses and exiting. That's like what we're doing. That's the thing. And so, but you exhaust yourself, you exhaust your bandwidth, and you can't actually continue to stack all these businesses on top, right? So fractional acquisitions allow for wealth stacking with the same exact capitalize, grow, exit format, okay? without having to put together another heavy lift deal for yourself, right? Okay. Now, this thing we're talking about today has this little special element to it. Now, I'm going to read this whole slide to you. I'm not going to read it. Actually, look, here's the thing. The point is, all of Silicon Valley and all of like Manhattan make like huge sums of their money in IPOs. Okay? And if you read Rich Dad Poor Dad, okay, it's actually a trilogy of books. Did you actually know this? And then he kind of kept writing. But like the third book was this one. And if you read the book, you actually understand that what he's trying to do is find a pre-IPO deal, okay, to invest in because of the lift that happens in that specific market. So I think that this is a little extra kind of exciting edge that we've got, okay? Now, here's the thing. I have, this was going to be buy then build wealth, but like I got buildwealth.com, so it's just that simple, right? So the concept here is I have a little bit of a vision, okay? And this all starts with in February of this year, I sent an email out to you guys, okay? And I said, look, I know I'm the buying a businesses guy, but you know, I invest in real estate. Surprise, right? You know, and I've got my A team, and I probably have more money invested with them than anyone else. And like, there's this, I'm investing in this thing, and there's this little bit of like 1.35 million. I just thought it would be kind of cool to see, like, do you guys want to invest with me? And the result was, we had a soft commitment of $4.5 million in 4 hours. And that's when I realized, wow. I was like, okay, there's interest in this. And then I realized, I wonder if we started putting everyone together around certain deals, the impact that we could actually have, right? And then that's when my brain started saying, like, okay, well, wait a minute. If I'm going to do this, and then I've built up a little pipeline of deals, okay? But the thing is I was like, in order to sort of launch this concept, I need a deal that is like so meaty, right? So worth talking about that we can like put a whole big event on and like talk about it, okay? And that's what we're going to do today. And the thing is like, I want you to understand, I've done extensive diligence on this deal. I invested in this deal that we're going to talk about today in February of this year, okay? On paper, I'm already up 50%, okay? I think this is still the early innings, and like this is going to be the last raise for the biggest gain, okay? And you'll see this all unpacked today. But the point is that like I invested sort of as a limited partner with sort of limited partner level diligence, right? I knew the team, I sort of knew the deal. I'm friends with Oren, and I have a mutual friend in Jake. I knew this deal was coming. Jake was working with Oren on the Game of Money presentation for like a year before all of this deal came out. So like I knew it was coming. It was like, okay, here's that deal I've been hearing about. Like here's a little bit, here's an investment. But when I got this idea after February of this year, it was sort of like, okay, I've spent a considerable amount of time with Oren. Okay. I hired 2 legal teams to go all the way through all of the paperwork, all the filings. I hired Centurica, right? And their CPA came in and reviewed all of the bank statements and the business model, and even found a couple of things that were a little off, and we worked them out. I talked and met with the CEO. I met in person with the supplier from Italy. Okay. I met the single largest customer who's writing all the POs. Okay. And we've put this whole event on, right? So I think that the point is like, I have this vision where all of us can come together and have a bigger impact than I would on myself. And that's why I'm sharing this with you today. And so when I went to Oren, I flew out here and I spent a weekend with them, and I said, look, I want this whole piece. Give me the whole piece. And here's the deal. We're going to fill it because I'm going to take it out to our community. And as a result, I want special terms. Not only do I want it all, but I want special terms. Okay. And you'll find out that, you know, we've got a pref that's even higher than the one in the last raise. Okay. So like, there's a lot that's gone into this, and I just want you to understand that this is all part of a bigger vision, and there's a lot going on here. But again, I wanted to sort of launch this with the single best deal that I could find. And this one checked all the boxes. I hope you agree. And, when you look at this deal, I want you to understand, like, okay, what does Walker see in this deal? What are the characteristics that he's looking at, and what makes it a strong concept here? Okay. So all that being said, thank you so much for being here today. Thank you for being online and logging in.